June 26, 1995, a day that would forever scar the annals of finance, when the United Kingdom's oldest merchant bank, Barings, announced its collapse in a single trembling press release. Barings Bank has ceased trading. The headline echoed across trading floors worldwide, but the true story began 3 years earlier, in the quiet offices of a single trader who, armed with ambition and a reckless belief in his own invincibility, would bring down a 233-year-old institution. This is the saga of Nick Leeson, the rogue trader whose actions ignited the Barings Bank trading scandal trial of 1995, a cautionary tale of hubris, oversight failure, and the relentless pursuit of justice. Barings Bank, founded in 1762, had survived wars, revolutions, and economic depressions, building a reputation as a venerable pillar of British finance. By the early 1990s, the firm's fortunes were modest, its capital thin, and its appetite for high-risk profit waning. In this climate, the bank turned to the exotic world of futures trading to inject fresh vigor. It was here, in 1992, that a young, charismatic graduate of the London School of Economics, Nick Leeson, arrived in Singapore as a clerk on the back office of Barings' newly formed futures division. Leeson's talent for numbers and his uncanny ability to charm senior managers soon catapulted him into the role of general manager of Barings Futures Singapore, a title that combined both front-office trading and back-office settlement responsibilities. In the world of finance, the segregation of these functions is a fundamental safeguard. By allowing one individual to control both, Barings unintentionally opened a door to unchecked manipulation. Leeson began to place massive bets on the Nikkei 225, betting that the Japanese stock index would rise, a strategy known as long straddle. When the market moved against him, he concealed the mounting losses in a hidden account labeled 88,888, a secret ledger that existed only on his personal computer. The early 1990s were turbulent for Japan. The country was emerging from a prolonged recession, its asset bubble having burst, and the Nikkei index was in free fall. Leeson's positions, initially profitable, soon turned catastrophic. Rather than cutting losses, he doubled down, betting even larger sums in a desperate attempt to recover the deficit, a classic gambler's fallacy. Over the next 2 years, the secret account swelled with losses that would eventually exceed £800 million, more than twice Barings' entire capital base. The unraveling began in early 1995, when a routine audit in London raised questions about the unexplained 88,888 entries. Yet, the bank's senior leadership, still dazzled by Leeson's previous successes, dismissed the concerns. It was not until the Kobe earthquake struck on January 17, 1995, sending the Nikkei plunging further, that the truth could no longer be concealed. Leeson's position deteriorated overnight, and the hidden losses ballooned to an irreversible magnitude. On February 26, Barings' London headquarters received a frantic call from its Singapore office. The bank could not meet its margin calls. Within days, Barings filed for compulsory liquidation. The scandal sent shockwaves through the financial world, but the legal battle that followed would become a landmark case in corporate accountability. In March 1995, Nick Leeson was arrested in Germany while attempting to flee to Hong Kong. Extradited to the United Kingdom, he faced charges of fraud, false accounting, and negligence. The trial, held at the Old Bailey, began on October 23, 1995, under the watchful eyes of a global audience. The prosecution painted a portrait of a man who, driven by greed and a thirst for recognition, deliberately concealed his losses, falsified records, and misled senior executives. Key evidence unfolded in the courtroom. The infamous 88,888 ledger, a series of forged documents, and testimonies from Barings' senior managers who admitted to the breakdown of internal controls. The defense argued that Leeson was a scapegoat, that the bank's culture of aggressive profit-seeking and inadequate supervision created an environment where a single rogue trader could thrive. They highlighted the lack of segregation of duties, the absence of real-time risk monitoring, and the pressure placed on Leeson to deliver impossible returns. After a week of intense deliberation, the jury returned a guilty verdict on November 1, 1995. Leeson was sentenced to 6 months in prison, a term considered lenient by many, followed by a substantial fine and a lifelong ban from the securities industry. The judgment underscored a critical legal principle. Individual criminal liability does not absolve corporations from civil and regulatory consequences. In the months that followed, Barings was purchased by the Dutch banking giant Ing for a symbolic £1, a transaction that salvaged the remnants of the firm but left an indelible scar on its legacy. The aftermath of the Barings collapse rippled far beyond the balance sheet. Regulators worldwide tightened oversight, introducing stricter requirements for risk management, segregation of duties, and real-time reporting. In the United Kingdom, the Financial Services Authority, now the FCA, mandated that banks maintain robust internal controls, while the Basel Accords reinforced capital adequacy standards. The scandal also inspired a new generation of compliance officers, risk analysts, and whistleblower protections, all aimed at preventing a repeat of the 88,888 debacle. For the financial industry, the case became a textbook example of how unchecked ambition can erode even the most venerable institutions. It reminded CEOs that profit without prudence is a fragile foundation, and that corporate governance must evolve faster than the markets it seeks to dominate. Subscribe to The Verdict for more stories like this.